Welcome to the Daily Update, where I'll go over the action in the market for Friday, June 16th, and then we'll see how things look for Tuesday, June 20th. The markets will be closed on Monday in observance of June 18th. We had kind of a down day. We didn't really do a lot of technical damage. We didn't do a lot of repairing either from being in this overbought condition. Things are still quite overbought. We were down a little bit. It was options expiration for quadruple witching, so that made the day kind of weird. What we're looking for now is how's the market going to react next week to what happened in the previous week. We had a real strong run up. It looked like things were just crazy going up. Is the market going to get some sanity and start to go back down? Are we going to chop sideways, or will we be able to continue to go higher? Even though we're overbought, we can still always go higher from here. We just want to know that the market has run up pretty far, pretty fast, and it still looks that way even after Friday's session. Before I start, I do have a supplemental video that deals with protection or hedging that some of you may find helpful. I do have a PDF that you can download to look at the slides and charts that I use. I have a private Facebook group. I will be going over the results of this week's poll in the weekly video, and then I'll be posting a new poll for the upcoming week. One thing I want to say is I get some of those crazy YouTube comments, and if it has a name in there, like go to this genius, Martha Smith or something, or I made $75,000 last week trading crypto, or if you ask some kind of unanswerable question, I ignore the unanswerable questions, but I immediately delete all of the other comments. I want to keep the comment section, even though there's not a lot of activity in that spot, I want to have that full of integrity. I want real honest back and forth going on. If you're just stating an opinion, that's fine. You're welcome to do that, but I may not answer that. If you have a legitimate question, or if you have a dispute or something that you don't like or do like in what I'm doing, that's no problem. That's what it's there for. But because of all the spam and garbage and crap comments, I keep a real close tab on that, and if I see garbage in there, it immediately goes away. So if you ever do post something, don't put a name in there. Don't put some kind of a number as far as money. And please try to put something in there that I am actually able to answer. That means that you and I can go back and forth a little bit more. Additionally, I also post these same videos on Rumble if you prefer that, or if you can't find me on YouTube. Let's go back and talk about what happened. We had a slightly higher open. It actually looked like we were going to have a negative open. The futures were down, but right after the open, we shifted more higher, and prices stayed near the unchanged level. It was a real quiet day compared to what we have been seeing. As the day went on, prices fell below the unchanged level, and then we ended up closing at the daily pivot at 44.09. So we're still above 4,400. That's positive. We were down 0.37%, and volume was way above average because it was options expiration. The technicals, as I said, are still positive. We're overbought in the short term as well as the intermediate term. Long term, we're showing some improvement, but we're not overbought in that area because of this inflation and interest rate scenario. What are some comments that we can make? I've said this before, it was quadruple witching. That's kind of its own little beast, so we have to just deal with that as it's happening and then see how things unfold next week. We're still dealing with this idea of FOMO. Back when people should have been getting into the market, it didn't feel like the right thing to do. Now that the market's going up, it feels like the right thing to do, and if we trade based on our emotions, we're almost always going to be wrong. And when a lot of people are jumping in for the fear of missing out, that can sometimes signal some kind of a top. The S&P did close the day as well as the week above 4,400, so this will help not only our daily charts but the weekly charts. The ADX line is still positive. That green line that's above 40, it's coming down a little bit, but it's still well above 40. On a short-term basis, we have the short-term ADX. Even the ADX is above 40 on our shorter-term chart. We have the short-term moving average, the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the standard deviation chart, the CMB composite index, the boom indicator based on 20 periods, and then the shorter term RSI based on 9 periods that we use. Intermediate term, we still have the Sean trend meter, the Arun, the PMO study, the RSI a little further out based on 14 periods, the other boom indicator study that we look at based on 50 periods, as well as the NASDAQ 100 BPI. The dollar was up and interest rates were up, and that put some pressure on stocks. We still have all of the yield curves that we're watching that remain inverted. Sentiment, it even ticked up a little bit to 82. So we're extreme right now. We're getting into that exuberant area. Now, we could still go higher from here. When we get to these extreme readings, we start looking to make contrarian moves, or at least backing out of this positive move that we've been in. Our trend is still positive. The green line's coming down, so it is declining, even though it's well above 40. The ADX, though, is still above its moving average, and both of them are above 20. I've changed our bias to positive/mixed. We don't know how things are going to react next week, and we did have a slight down day. I'm also switching our momentum to positive and mixed. Even though we've been up really strong, it's positive overall, but because we're so overbought, it wouldn't really be a surprise for us to go a little bit sideways, slightly down. We'll be evaluating that if we do start to fall to see if the overall environment is going to shift. The economic reports that came out, we just had consumer sentiment. It came in at 63.9. That was better than the 60.2 that they had expected, and I have a chart to show you. Last time it was at 59.2. A year ago it was at 50. So people are feeling a little bit better about things. Some Isabel net charts. We look at this in the weekly video when I go through the current market valuation. This is showing that margin continues to be quite low. This could be positive for the market because people go out and borrow money from their broker to buy stocks. It's at a real low level right now. And if we really start screaming to the upside, this could go up and add more fuel to the fire, so to speak. Then we look at a long-term chart of the 240-week moving averages. I show this in the weekly video. We're well above this red line. This is the very, very long-term trend. And this is why my conclusion is that we are still in a secular bull market as long as we're above this red line. Other people may disagree with that. Now, in 2022, we went into a cyclical bear market. That's shorter term, but longer term, we still remain in a positive stance. Then the next chart is just saying that stocks are bouncing back from down days at a historical pace. They were up 0.27% after we have a pretty significant down day. Not really applicable to what we're seeing right now, but this could change at any time. Then we look at weekly equity fund flows, where the overall score is the blue column here, and that's been going up, and the 12-week moving average is also continuing to advance. Folks are starting to get back into stocks. Then we look at the 10-year Treasury yields coming out from Goldman Sachs. This is what they're anticipating, that right now we're at about 3.79%. We'll go up to 3.9 and then eventually get back down to 3.75. The futures markets are a little bit lower than that, but still fairly close to what Goldman Sachs is forecasting. Then, because we had the retail sales release come out this past week, we're looking at the retail and food services sales, where they were pretty much sideways, but still staying relatively strong. Then we look at sector fund flows. A lot of money going into tech. Now that's starting to come back out. The green line at the bottom is energy. That was really good in 2022, but is really underwater in 2023. Looking at our charts, here's the intraday chart where it looked like we were going to have a little lower open. It was pretty much flat, but then we saw some buying coming in. We never made it up to R1. We just chopped all around and came down and kind of danced with the unchanged level, bounced back up. Later in the day is when we saw some more weakness, when we fell back below the unchanged level and then came all the way down and closed at the daily pivot. On the negative side, we closed at the low for the session. On the positive side, based on the big run-up that we've had, this wasn't much of a pullback. Here's the intraday chart where we had been a little bit higher in the initial overnight session. Then we dropped and we're looking more negative. But then as we got closer to the open, things did improve. Here's the late move down later in the day, and as we end the trading week, we're pretty much flat. Looking at large cap growth versus value, they're both declined overall, especially later in the day. The blue line and the red line are pretty much on top of each other. Here's the closing value where growth was down more than value. For the mid caps, it was down a little bit more. I'm still getting this erroneous data, and so I've switched out the small caps chart to show you later on. Small cap growth did outperform small cap value in that it was down less. Here's the growth to value ratio intraday chart based on the SPY. We are seeing a little bit of weakness here where we did trail off in Friday's session. Sentiment still showing that there's no fear based on the Ulcer Index. We declined on the VIX with the line chart as well as the bar chart. In the VIX of the VIX, now that options expiration is ending, we're seeing volatility dropping off for the VIX. Equity put-call ratio still continues to go down overall, but we're not really working off of a recent signal. This is another long-term positive where we're rolling over with the 253 period equity put-call ratio. The VIX to move ratio shows that even though fear ticked up slightly, that there's not a lot of fear when you compare the movement in the bond market with the movement in the stock market. Here's an independent chart showing how bonds were up, so the MOVE index went down. We also saw a decline in the VIX, and at the bottom, their relationship is not as strong as it usually is, but is showing a little more strength. The SKU index, after going up into this red area, it's now starting to drop back down, showing that whatever event the market was anticipating, which could have been options expiration, is now starting to dissipate. This fear gauge shows that fear continues to decrease. Also, we had the latest reading from the American Association of Individual Investors. Because we had an up week, they're looking more positive on things, but we're not really getting to an extreme positive reading yet. Then we look at consumer sentiment, where it did bounce up. That's the blue line. It's showing some improvement, but we're still really far away from the 2-year Treasury yield. These tend to go in the same general direction, and even though they're on different scales, they tend to not get very far apart from each other. The spread between the two is still really quite wide. And then here's the other fear gauge showing that fear dropped off slightly. Folks are still favoring a risk-on posture, even though it declined in Friday's session. Advanced decline line came down a little bit based on price and volume, but overall we're seeing a real improvement with this, possibly to the point where we could negate this negative divergence. New highs, new lows, another strong day. This had really been lagging behind and was a source of concern earlier in the week. Now it's one of the stronger parts of the market. We've had 4 really solid up days of new highs, turning our 5 period up even though it's rolling over a bit, and our 10 period continues to advance. The advanced decline ratio declined a little bit but is still above 0. Accumulation distribution also declined but is above the moving average. We were seeing more of an improvement with the cumulative advanced decline line for the NYSE. It ticked down slightly and also ticked down with the regular advanced decline line. That's more the negative side, even though we're seeing overall improvement in this chart. The positive side is we're still above this trend line when we look at a different version of the NYSE advanced decline line. Common stock based on price and volume did tick down slightly. We are seeing some overall improvement. We want to see both of these lines continue to go up to take out this negative divergence. Broader range. The NYSE was down a little bit, but still above its moving average. The same thing with the S&P, the mid caps, and the small caps. Here's the longer term trend chart that we use where the ADX is really going up stronger. The green line's on top, but it is starting to decline, so we're a little bit leery of that. Shorter term, we have not only the green line, but the ADX itself above 40. That's suggesting on a shorter term basis that we are overextended. Volume really picked up in Friday's session because of options expiration. Our short-term analysis, we came down a little bit, but we're still above the August 2022 highs. You can see this real spike up on the bottom with volume. The 20-period exponential moving average declined slightly, but is still extreme. Rolled over, but still looking good with the 50 as well as the 200. We're coming down a little bit with our shorter term oscillators, but we're still extreme positive with the Stochk RSI, the Williams Percent R, the CCI 14, and the CCI 20. Our stochastics also rolling over a bit, but still extreme in the short, intermediate, and long term. Force index, which never made it up to the Keltner band, that's when I consider it going up too far too fast. We are still positive even though we declined. The CMB composite index did decline, but it continues to be extreme positive. Here's the boom indicator study. The 20 period, we're still above this, showing that we're far away from the 20 period moving average. We're also kind of far away with the 50, and we continue to show improvement with the 200. Intermediate term charts, the balance of power came all the way up and is no longer giving us this extreme positive reading and is dropping down. Connor's RSI also gave us an extreme reading and dropped. The go-no-go system remains positive. The TTM squeeze is positive, and we're starting to get up to this black line, which means we could get overextended. Here's a longer-term look at that same chart where it also shows that we're getting close to that black line. We're still working off a little bit from the standard deviation, but we're in the third range of the standard deviation, suggesting that we've still gone up pretty far, pretty fast. PPO study still remains positive across the board. The Erin is still giving us an extreme reading, although it did tick down slightly. McClellan oscillator had been giving us an extreme positive reading and has now dropped back down. The broader range NYSE also declined. It's above 0, and it's not as strong as the S&P McClellan oscillator, but it's still positive. The summation index based on price continues to show improvement, but we're still below this downward sloping trend line. Volume continues to look better. We have to keep an eye on this, though. If this continues to go up, we're going to be getting to an extreme positive reading on this indicator. The broader range NYSE summation index based on price, a little bit of improvement overall, but still lagging behind. The Elder Impulse system for the S&P has now switched to neutral. And the Swenlin trading oscillator based on price and volume did continue to advance, although we were mostly flat based on volume. The parabolic SAR is still positive. The PMO is still trending higher, and we're also going up based on price and volume. The PMO study is still extreme positive, even though it declined. The buy signals continue to be extreme positive. The PMOs that are above 0 show improvement. The slope is still headed higher, and the MACD is still headed higher. All of our oscillators continue to show positive momentum. Sean trend meter is back to being extreme positive. We're seeing a little bit of improvement with the BPI. We're breaking out above this previous high, but we're still lagging behind overall. We want to continue to see more improvement from this chart. The NYSE bullish percent index is also showing some improvement. We're above 50 and advancing. The Chaikin money flow dropped off, but is still positive. Chaikin oscillator also turned down, but is still positive. Ultimate oscillator turned down, but positive. The vortex continues to be positive. And we're keeping an eye on this green line. We're getting to a level where sometimes that is marked at least some kind of a slowdown. The money flow continues to go higher and is positive. On balance volume dropped a little bit, but is still positive overall. The RSI 14 coming down, but it's still extreme positive, and the 9 period is also rolling over, but extreme. We continue to see some improvement when we look at the 200-day moving average study, the S&P. Even though it rolled over, we're starting to go up with this chart, and our 50-period moving averages are also showing some improvement. Here's a longer-term look at that same chart. If you find having the color helps you see that a little bit better. The Copic curve is still on a buy signal, as is the Pring bottom fisher. Fibonacci, we're still above this 75% percentile. We're coming up into an area that could offer some more resistance. In longer term, we're above the 61.8% retracement level. The other fib charts I can't really show you now because they're not really telling us anything. Longer term, we're also above this retracement. The next higher level would be going back to the all-time high. This is another chart based on a post from Game of Trades. I'm not sure I follow along what they were trying to point out, but they drew a trend channel going back from this high back in December to another high that we set in February. On the chart that he posted, it looked like we were getting ready to bump into this area. Then, just for kicks, I tried to draw another line going from the low in October to the low that we set back in March. This is not parallel. You might look at this and go, wait a minute, they are parallel. No, they're slightly different from each other. This is why I don't really like these kinds of line studies. There's too much subjectivity in here, and you'll see it when I get to the next chart. I changed the chart around to an arithmetic scale, and if you draw, going back to this high, we've already broken above that. So the chart is just a little bit different. Just to keep it kind of fair, I drew the red line from the latter high, and that suggests that we still have more room to go. If you go back to the previous high, which was a double top here, we've already broken through that, and now we've come back down. Just to take this a step further, I drew another red line from the low in October to the March low, but that's not quite parallel. If I was to actually draw a parallel line, it would be going up like this and not really tell us all that much. And then I drew another parallel line going back to this upper line, and that really wouldn't be telling us all that much either. What he was trying to say in that post is we are in an ascending triangle, which tends to be negative overall. I'm not a big believer in those. I've studied different formations. I like trend lines, and when they make sense, they're great. But when you start looking at patterns, I've seen them fail as much as I've seen them succeed, and to me, that's not good enough. There's too much subjectivity that you have to put into these charts. That's where I come out. You may completely disagree with that, and that is just fine. Over the years, though, I don't want to have to think and put into the chart. I want the chart to tell me what it's already saying. I'm a little bit different than all these other folks. That's another reason why I don't use Elliott Wave. You have to put your own thought process into that instead of the chart telling you what's actually happening. Just be aware of that, and you might disagree, and that's just okay. Our different charts, we're still positive with the hike in ASHI, as well as the KEGI, the Renko, and the 3-line break. Some of our other indexes, we are showing some improvement with the equal weight, even though it was down, but it's still underperforming the S&P. The equal weight compared to the S&P did tick up just slightly, but overall the big stocks are doing better than the smaller stocks. We're still seeing this longer-term negative divergence, but we're seeing some real improvement with the transports. That could negate this if we see continued strength. Shorter term, we were seeing a negative divergence with the utilities, but we are seeing the utilities turning back up slightly. Even though the transports are improving, they still are underperforming the Dow. That could be longer-term negative. Then we look at our discretionary equal weight, where that fell slightly but is still in an overall uptrend. The staples are also in an overall uptrend. When you look at the ratio between the two, we turned down, but discretionary is outperforming staples. That's growth versus value, basically. The Dow was down, but is still holding up so far. The diamonds have switched to neutral. The NASDAQ came almost up to this R2 level and has started to come back down. We'll have to see. Is this just a pause? Are we going to turn and go in the other direction? Or will we eventually break through this R2 level? We're coming up to the 61.8% retracement, and so far that is acting as overhead resistance. We came almost up to that level and have now started to come back down. Is that going to be an issue? We're waiting to see that play out. If we see more weakness in the NASDAQ, then this may prove to be legitimate. If not, then we may be able to break through that. Internally, we're looking a little bit better. It's hard to see, but we're turning up when we take the cumulative new highs minus the new lows, because on the bottom, we've been above zero now for a number of days. But overall, this is still negative internally for the NASDAQ. The NASDAQ 100 never made it up to the R2 level. Will it try to break above that? We're also dealing with the previous high set in March of 2022. Is that going to provide some overhead resistance if we continue to go up? The Qs have now switched back to neutral. The NASDAQ 100 BPI is getting to be extreme positive again. The small caps, we're still maintaining things above this R2 level. That's positive. That means support is holding on this chart. But on this chart, resistance is still holding. So we have support on one side and resistance on the other side. And then I've kind of switched this over. Instead of using the small cap index, I'm now using the IWM small cap ETF, where we are also continuing to chop sideways. And the small caps continue to underperform the S&P. But when you look at growth versus value, we're still in an overall uptrend, even though it's been chopping around a little bit more lately. The mid caps were still above this R2 level, even though they were down on Friday. But for the Elder Impulse system, the mid caps remain neutral. When we look at growth versus value, we're seeing more strength in this chart. The blue line's over top of the red line, so we are in an overall uptrend. When we look at the broad market, they continue to outperform shorter-term bonds. The broad market is also outperforming longer-term bonds. The tech sector, even though it ticked down, continues to outperform the 3 to 7 year bond ETF. The S&P is still outperforming bonds, suggesting that the market thinks we might hit a soft landing. The inverse of that same chart shows the weakness in bonds. We're coming down now. We'll see if some of these previous areas act as some kind of support. Keeping an eye on the financial sector, down slightly and still in an overall downtrend. The financials, they ticked up but are still underperforming the S&P. The regional banking ETF came down a little bit and is in an overall downtrend when compared to the financial sector. Looking at bonds for the 10-year, the yield was up and price was down. We're still above this 200-day moving average based on price. We're seeing a little bit of improvement with the long-term correlation. It's starting to turn back up. We'll see if that continues. And the 10 period is also showing some improvement. The spread is still really wide, even though it ticked down slightly. Folks are still preferring riskier bonds over more conservative bonds. And when we look at cash versus bonds, we're starting to go back up with this ratio. When I did that supplemental video a month and a half ago, we were really going down with this ratio. So this still is producing some concern. We look at shorter term versus longer term bonds. We're coming back into the rainbow. And then when we look at longer term bonds and shorter term bonds, we're also coming back up into the rainbow. We look at the value to growth ratio, which is the black line, and then compare it to the 10-year treasury yield, which is the red line. They have a tendency to go in the same overall direction, and their correlated relationship is very strong. We're also keeping an eye on the 3-month yield. We're still above levels set back in 2007, wondering if this is a longer-term warning sign. Our long-term analysis, this is positive. We're starting to break above the red line, and every day now, we're going a little bit more above that. When we look at the rate of change going back 200 periods, you might seem to think that we're getting extreme positive, but on a longer-term basis, yeah, we're coming back to previous highs, but this chart is showing some improvement. An update of our possible positive scenarios, we're still looking okay based on price, even though it declined. We're coming down based on volume. We're right below this green line. So we're wondering if the market's going to do more backing and filling. The Qs turned down slightly against the S&P, but are still outperforming. The same thing with discretionary as well as large cap growth versus large cap value. The growth to value ratios turning down with the large caps, mid caps, and even the small caps. The S&P to utilities ratio still continues to go up. That could give good support to the S&P. Looking at the percent of stocks that are above their 200-day simple moving average in the S&P, we are showing some improvement. Now, even though we had the down day, this chart is continuing to go up because it takes a while for things to change with the 200-day moving average. We're still looking positive with our broad range when we take a 5-period moving average of the highs minus the lows, since we are above zero. The 10-day average of the S&P high minus the lows, we're starting to get extreme positive. This lags a little bit. We could get up into this area and stay there for a while, or we might get extreme positive and then start to come back down. We're waiting to see what will happen with that. Longer term, we're still looking more positive with our 50-day exponential moving average of the new highs minus the lows, and the indicator itself is really showing a lot of improvement. If we continue to go up, we're going to be keeping an eye on this 80 level. That could mean a little extreme positive reading, even though we could go well above that. S&P growth to S&P value is still in an uptrend overall, but we're starting to see some weakness. That's a little bit of a concern. The Staples to S&P 500 ratio ticked up slightly, but overall continues to decline. This has been giving good support to the S&P, even though we missed out a lot on the upward move in the S&P as this ratio was going down. So what's our outlook for Tuesday? The markets are closed for Juneteenth. We do have the Bank of England that will be meeting this coming week. The technicals are positive, but we continue to be overbought. Some of the negatives and negative divergences, they're still there, but they're showing improvement. The economic reports coming out on Tuesday will be housing starts and building permits. The whole list of geopolitical events with the inflation and interest rates being the real focus. Here is the economic calendar for the upcoming week, just to give you a bigger picture look at that. Here is the speaking schedule for the Fed members. The important one will be on Wednesday and Thursday, where Jerome Powell will testify before the House Financial Services Committee. This is a meeting that he has to do twice a year. That'll happen on Wednesday, and then on Thursday, he will speak in front of the Senate Committee on Banking. What'll happen is we pay attention to his opening comments, and then he'll repeat those same ones on Thursday. It's the Q&A that we really focus on to see if he lets anything slip that the markets can react to. The Stock Traders Almanac statistics for June 20th were neutral to negative with the Dow, where we're neutral to positive with the S&P, and we're actually positive with the NASDAQ. So we're getting a whole range of things on this. We will be on the 13th trading day of the month on Tuesday. We're also looking at the NASDAQ, where it tends to perform on a historical basis pretty well until about the mid part of July. Our scenarios can't really go with the down one now unless you are completely convinced this overbought situation is going to turn into a negative downtrend. But our charts are just not saying that. We're still positive overall, even though we remain overbought. And we can't really go with the sideways one right now because we are really showing a strong trend. Our warning signs. In the other markets, the BPIs are diverging, but we're seeing improvement with the BPI for the S&P. The negatives and signs of weakness, they're still there, but they are showing improvement. The VIX is still showing that fear is very low. The cumulative new highs and new lows, even though they turned up overall, they're in a pretty broad decline. The 3-month yield is still back above where it was in 2007 before the financial meltdown. The small caps generated a recent death cross, but we've been seeing some strength. As of right now, they're still holding up above support. Earnings still has to be dealt with on a day-by-day basis. Our positive signs. We still have the seasonality charts and the setups that remain. I'll probably go over those in the weekly video. The new highs, new lows are really showing a lot of strength now. The special K indicator is really looking a lot more positive. The equity put call ratio is also turning more positive when we look at that long-term moving average. The Coppet curve and the Pring bottom fisher continue to generate buy signals. We're still above that downtrend channel upper line, even though I didn't show the chart. I'm looking at it every day. We're still in a risk on posture. We may get some support if we start to drop at lower price levels. The S&P continues to outperform utilities. The NASDAQ is still holding up really well. And the staples are really underperforming the S&P, which could be positive for the S&P. The mid-caps have generated a recent golden cross. Small and mid-cap growth, even though it's going down a little bit, is still in an overall uptrend. So our conclusion, the S&P, it's positive, but it continues to be overbought. We still have those negative things in the background, but some of them are improving. If we see some downward movement, we might see a real disintegration of what has been improving. Short term, we're still positive, but overbought, as well as the intermediate term, but long term, we continue to be positive. Thank you. I hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.